Well, the market's kicking off this shortened holiday week in rally mode. The tech trade popping as the odds of a Fed rate cut continue to climb. The December odds of a cut now back around 70%, up from 33 on Friday. So will the momentum carry into December? Joining us now is Truist Wealth Chief Investment Officer Keith Lerner, Morgan Stanley Wealth Management Executive Director Dan Skelly. Guys, happy Monday. Keith,
happy Monday.
Is this market still priced for perfection? Or I guess enough of it, because it's the exciting names, or the excitable names at least, that seem to move things today.
Yeah, well, first, great to be with you. Luckily, the market gave us something to be thankful for, at least on this Monday. I don't know that the market's priced perfection. I do think after one of the strongest 6-month moves we've seen in history, that it did get overstretched and sentiment became, a little bit euphoric in some areas of the market. But we've done a pretty good job of resetting that. If you look at some of the meme stocks as an example, since the October highs, they're down about 40%. And, the S&P is down, its first 5% correction we've seen since April. And as we look at the Nasdaq, or the technology sector, coming into today, we had the most oversold conditions since April. So I actually think we've reset the bar pretty well. And I would say that we're still positive in tech. And we were saying last week to use the weakness, and we'll still say that today in tech, because we still think ultimately tech still moves higher, supported by much stronger earning trends than the overall market.
Okay. Dan Skelly, I believe you are looking at healthcare as being under-owned and priced for pessimism. So I guess you don't think the whole market is priced for perfection either.
Yeah, and we like sectors like healthcare, which seems to have put in a definitive bottom in the last several months. We think we're past the point of maximum policy uncertainty. We saw fairly healthy earnings trends across med tech, tools, and life science, and even big pharma over the reporting season. And this is a sector that is anti-correlated to a lot of the AI trades, and so it gives you a little bit of true diversity in a portfolio.
Keith, want to get your thoughts on the volatility we're seeing, not just in stocks, but also in the Fed funds futures, given what we've seen in terms of volatility of Fed speak as well. I just think about what we heard on Friday, what we're hearing today, most recently from San Francisco's daily, just maybe an hour and a half ago. How do you factor this into the investment thesis?
Yeah, one, I would try not to overreact, but it's notable that the S&P 500 actually peaked the day of Powell's comments, where he pushed back against an automatic December rate cut. But what you are seeing since then, there was two things that have been in question: the AI trade and whether the Fed's going to cut. Now, today we've seen the AI trade back in vogue, and then we're seeing the market now price in the rate cuts again. So that is certainly helping. I would say, though, if we zoom out a bit, looking the next 6 to 12 months, we think ultimately the Fed does cut rates and that earnings do move higher. So we think ultimately that will allow the market to move higher. And I would probably say, don't try to get wrapped up too much in the day-to-day and whether they cut in December or not. Ultimately, we think they are going to cut, and ultimately we still think profits move higher. And I think, you still want to give this market the benefit of the doubt.
Here's an interesting stat for you, Dan. November historically bottoms on November 20th before the seasonal late month rally. What's more interesting is that one of the weaker parts of the year is actually November 18th to 20th. Looks like we're kind of on track here from a historical standpoint. So if we're talking about a secular bull market that's still on track, what powers it to the next leg higher?
Sure. So, Morgan, I don't know if anyone can predict the day-to-day ongoings of the market, given everything we're seeing this year. But I would say I think this mini correction is over. It was a 5% drawdown, peak to trough. It was really quite honestly nothing. And we do see the market continuing to take off into the end of the year, into the beginning of next year. And that's driven by earnings broadening out across other sectors, continued power and productivity advancements around AI. And we do think the Fed is going to be cutting into next year. So those are the catalysts going forward. I would just lastly say I don't actually mind the fact that everyone keeps talking about AI bubbles and AI crashes. What we saw over the last couple of weeks was more like an AI fender bender, right? It's really not the type of thing to concern people.
Keith, what's the major danger for the market in December? Over the last few years, we've seen some pretty serious accidents in the market at the end of December.
Yeah, it's probably something we're not talking about, which catches us from left field. But I will say, I don't think this is a major danger, but now the market has now shifted the Fed funds futures or a cut in December to 80% if we certainly kind of go back to close to zero. I mean, that is a concern. We also have maybe some news around the tariffs, which could be a concern as well. But I ultimately do think that we will rally into December. That's our base case outlook. And historically, we are in a seasonally positive period of the year, coming off kind of an oversold condition now. And I think we have enough to make some headway into year end.